On inflation, have you changed your mind on how quickly central banks should move on? I think in December you said that they would have to be in a wait-and-see situation to have some concrete data before they acted.
I think my take, and by the way, it's good morning. It's great to see you again, Francine. It's just lovely to be here again. I think that the point that we've been quite consistent of for quite a few months now is that the risk of a policy mistake by being too hawkish was probably the bigger risk on a balance of probabilities, which is not to say that there aren't quite significant challenges in the inflation picture. And I think we probably stand by that, particularly now when you see that we've got this tension between, yes, rising inflation, but at the same time, some real signs that maybe the growth picture is not quite as rosy as it was 4 or 5 months ago. And that's a combination of Omicron, but just the way the whole supply chain challenges have played out. And I think if you're a central banker right now, you're in that kind of catch-22 situation because you don't want to kill growth that might already be under some pressure. But at the same time, you've got this big challenge on the inflation front. If you unpick the inflation challenges, they're quite different in different parts of the world. I mean, one of the things I think is very striking is the fact that inflation numbers look much worse in the US to the way they look in Europe. In Europe, there's still a challenge, but of course, still significantly higher than, for example, Japan. So the inflation picture is playing out for a whole host of different reasons. And it's not clear that those reasons will necessarily respond quickly to interest rate rises, which suggests that maybe interest rate rises aren't always the answer.
Yeah, and you're pointing to the fact that actually, part of the reason, if not the majority of the reason people think that there's so much inflation is, of course, because of supply shocks rather than, a healthy economy with much more demand. So do central banks need to adapt their language to communicate better with the markets, or how do you think this will play out? Like the market reaction to what the central banks are saying more than doing?
So I think there's two things that are really worth thinking about. I think central banks are really keen to manage our inflation expectations. They care more about our inflation expectations than they do about absolute levels of inflation. And I think you can already see that by the responses that there have been out there. The second is, I think there's a very close attention paid to real yields, because when you look at those long-term macro trends, very high debt levels, and a more challenging demographic, short-term lifts in inflation because of changes in demand pattern, because of changes in employment choices, and because of that supply chain disruption, they're all relatively short or at least cyclical issues against that very long structural shift that you've got going on with demographics and with high debt levels. And so I think it's the real yield that really the central bankers are most focused on, because it's if that rises significantly, certainly if it gets above zero, then you start to have a real risk of a very hard landing. And I don't think that is on anybody's roadmap. So as a central banker, I think that's what you're playing with right now. Yeah. Get our inflation expectations down matters more than the absolute level of inflation today.
And so what does it mean for the markets, Anne? Is this the right time to bet on parts of the markets that could benefit from the end of the pandemic?
Well, I mean, end of pandemic, that's a really big statement out there. I mean, what do we mean by the end of the pandemic? Do we mean just adjusting to the fact that we're going to have ongoing waves over periods of time and we need to get better at adapting to them? I think for what it means for markets is that I think central banks, if they see the inflation expectations maintained under control and they don't see real yields getting out of control, I think probably will be at the margin more dovish than the rhetoric today suggests, which means actually probably, although this volatility is likely to continue for some time, actually that's not a bad bedrock, because the worst of all scenarios is rates that rise too hard, too fast, and squeeze off what is quite a fragile economic recovery. I think the final point I would make is that there are parts of the world, and China is the most noticeable in that, where they actually, because they've taken a very different approach to the pandemic, they're looking for maybe easing rather than a tightening agenda, which you're seeing in other parts of the world. And we need to have space for both if we're going to keep the global picture of recovery and growth on track.
Is China actually, because of that loosening of policy at the moment, does it help the rest of the world in achieving some of their targets?
I think we need multiple different levers to keep the growth engine going. So if China can keep the growth engine going, it gives a little bit more of an umbrella and more flexibility, perhaps, for central bankers to adjust more dynamically what they need to do. But I think there are some signs that we're close to the peak in inflation coming. And I think, therefore, if you look at the different tools that central bankers have, there's interest rate hikes, there's tapering, and then there's actual balance sheet shrinking. They can pull on a number of different levers in order to manage the path from here. And probably they will adapt those levers according to the growth picture as much as looking at the inflation picture.
And we're spending quite a lot of time also on the surge in the cost of living in the UK, but also really almost in most places in the world. What can governments do at this point to try and help with that? And is the market ignoring it? Because we're focusing on inflation from a very economics point of view without really thinking about what it means for a lot of families.
Well, I think this is where it's separating what are short-term spikes versus what is real structural change. And I think, the energy is obviously one significant part of that. And I think there are interventions that governments can continue to target those for whom that is a significant part of their weekly wage bill. And obviously it doesn't affect everybody in the economy equally. So, I think there are specific interventions that governments can do about some of those big chunky things. But I think some of the other pressures that people are seeing in the immediate shopping basket, for example, some of those will play out because I think you're seeing increased demand in part because supply chain disruption has meant that people couldn't reliably get stuff that they need to. So you're seeing over-ordering, which is creating additional supply chain pressure. And as that supply chain pressure gradually teases its way out through the system, I think some of those pressures that we're seeing in people's baskets will filter out. Some are a little bit more longer term, for example, like energy. And that's where governments do need to look, I think, at the interventions on a country-by-country basis that are appropriate for that individual economy. And it will vary. As I said, Japan's inflation picture is very, very different to the UK's or the US's, for example.
When you look at 2022, and I want to focus a little bit on the UK, is there anything that the government can do today to try and alleviate some of those labour shortages that have been quite acute and pronounced in the last 15 months?
I think people have been making lots of different personal choices, again, globally, not just in the UK, about how and when they spend their time. And that includes how they engage with employment, with the workplace. Yeah. And it has changed it's not changed for everybody, but it has changed for quite a lot of people. So I think if we're thinking about how we encourage more people into the workplace, we have to think about what, as an employer, we spend a lot of time thinking about this, what is the proposition that you are offering to an employee? There's a piece around training and skills. Can we get better and more imaginative about the way that we train people to make it much more easy for people to self-select into the sectors, into the job vacancies, which they clearly are there, because we do have pockets of systemic unemployment at the same time as we've got these challenges with vacancies. So I think that's really important. And then how do we keep people in the workplace for longer? I think people now have much more appetite to work past what we used to think of as normal retirement age. How do we take people who've had career breaks? How do we make it easy for them, again, to skill up and get back in? So I think we've got to get really imaginative. There's no one single bullet on this. There's a whole range of different things. Government can do a bit. Employers need to be really imaginative and work together to create some of these mechanisms, as indeed we are doing.
Yeah, and Anne, you're also chair of City UK. What does Britain need to do differently to get, regained some of the ground lost because of Brexit? Is there a specific, point in which regulation needs to change to be more attractive for the UK?
Well, first of all, I should make really clear, I do not take over as chair of City UK until the 1st of June. So Mark Tucker is very firmly in that seat. And I'm not going to try and second guess Mark. But I think more generally, if you look at... No, it's okay. It's fine. I'm really looking forward to it. And one of the reasons actually is it's the first time somebody who's not from the banking, not from the insurance sector has chaired, which I think actually, to your question, it's part of the understanding that we need to think about the whole financial services ecosystem and how that relationship with the EU and actually with of course, much broader, international counterparts that we have, how that is going to work. And I think thinking about that interconnectivity is going to be, a crucial part for financial services. I think more generally, in the post membership of the EU world that the UK is now in, large companies, for the most part, have adapted pretty well and pretty quickly. I mean, there are still some challenges. I think everybody can see that, but it's been easier for them to do it. I think that the emphasis over the next year or two will definitely be helping the smaller and the medium-sized companies figure out how they navigate what is a different regulatory landscape, what is a different import-export landscape, and they don't necessarily have the resources and the capability that the larger firms do. I think that's one of the ways that we get through some of the logjams that we've maybe seen in the short term in this post-EU world that we've been navigating.
And when you look at central bank digital currencies, is there a risk that actually we'll be too late to it, given the pace of evolution in fintech in general?
Yeah, I think this is an absolutely fascinating area. And I think there's a lot of, in the supervisory and the regulatory and the central bank world, there's a lot of angst going on at the moment. To what extent do you let innovation go? To what extent do you need to step in and regulate? And is there a systemic risk that could build outside of the regulated sector, because in fact quite a lot of the innovation is happening outside of it. And so I think that the smart regulatory environments, the smart countries, will be thinking about how they create the ecosystem that doesn't just encourage fintech, that doesn't just encourage innovation, that also thinks in parallel what's the right way and a robust way to regulate that in a way that doesn't kill innovation, but makes sure that systemic risk can't grow outside what we currently think of is the financial system. And I think there is a bit of a risk of that at the moment. And it behoves, I think, regulators and supervisors really to get their act together and to accelerate a joined-up approach to this. So we don't just try and stimulate innovation. We get innovative about the right regulation that doesn't kill it, but encourages it safely.
And from next week, actually, the rules are changing about returning to the office. We heard that from the Prime Minister Boris Johnson. How are you expecting that to play out at Fidelity, but also, more generally in your industry?
Well, of course, we've had different offices. We're in more than 25 countries globally. So, we've had some people back in the office, for months and months and months. We've had other people who've not been in an office for the best part of 2 years. It really does vary enormously depending on where in our world you are, but specifically for the UK, where we've got quite a large number of people, our offices have been open with a skeleton staff all the way through, but we will be encouraging more people to come back into the office, but very much observing the same kind of sensible protocols, because Omicron, yes, it looks like it's under control. Case load numbers are falling, but we're not through it yet, and we monitor staff sickness absences very, very carefully to make sure that we don't have an operational hit from that. So yes, I'm looking forward to physically being back in the office again next week.